right, Holly, ready for you to kick us off.
All right, let's go. Well, hi everyone. Good afternoon. Hope you all had a great lunch. We are thrilled to be part of this workshop today and to be presenting to this esteemed audience. People say follow the money, and today we'll explore how financial decisions have the potential to shape resilience in commercial real estate. We hope to serve as emissaries from the commercial real estate lending and development space and share how risk management is evolving, informing how the stakeholders here in this workshop can leverage CRE risk management processes to drive change. It's clear from all the presentations so far today that the data is there, the engineering know-how is there, and the challenge before us is to build on the strength of all the work that has been done to date to actually improve decision making and therefore drive change at scale. So through this conversation, we can help paint the picture of the current state of commercial real estate risk management while providing signals for where the market is heading. These signals may suggest ways to influence risk management processes so that CRE stakeholders are more likely to consider resilience. We can also explore how insurance, lending risk management, codes and standards, and all of that touches on and connects with investment and how people consider the life cycle ROI versus the upfront cost of resilience measures. We can dive into all of that, some of those themes that have already been brought up this morning. So before we dive into our discussion, let me set the stage by outlining the key stakeholders in commercial real estate. First, we have developers who take on the initial risks of bringing new properties to market or renovating existing ones. They're the ones making crucial early decisions about resilience features and building specifications, as Liz mentioned earlier. Then we have our lenders, commercial banks, credit unions, and other financial institutions who provide the capital that fuels real estate development and acquisitions. Their underwriting criteria and risk assessments significantly influence how projects are structured. Investors and owners form another critical group, ranging from institutional investors like pension funds and real estate investment trusts to private equity firms and individual property owners. Each has different investment horizons and risk tolerances that affect their approach to risk and resilience. Insurers play an increasingly important role. It was so great to hear from FM earlier, as their policies and premiums can significantly impact the financial feasibility of projects and ongoing operations. And finally, but not least, we have our communities, the businesses, residents, and local governments that are directly affected by and intersect with the resilience of our commercial properties. So now, Willie, I'd love for you to take us deeper into how these stakeholders interact. As a risk management expert with an extensive background in development, as you are, these aren't isolated players operating independently. There's a complex web of relationships and overlapping interests. Can you help us understand how these different roles intersect and influence each other?
Absolutely. Holly, thanks for that great introduction. I'm happy we have 2 hours to do this. You know, the developers, lenders, owners, investors, I mean, it all sounds like different silos, but they're really not. I mean, we all work together to bring a project to fruition, and one without the other doesn't work. And what's even more interesting is, like, I was part of a huge development firm, and we did everything but the lending in that equation. Okay, um, so it's not silos as much, and we all have common interests, and at the same time we all have different priorities. Okay, so I think that's part of what we're going to be exploring today is some of those differences and touch upon how Mary Claire and Jeff and I see the world from our with our goggles on of who we're representing right now. But it's not that we all haven't touched all these different facets of it, right? And so I'm honored to be in front of you, and I'm honored to be presenting with Mary Claire and Jeff and Holly, who are all leaders in their own right in their fields.
Thanks, Willie. And yeah, we aren't doing intros because you do have the bios, but this is a great panel. I'm so honored to be here as well with them. And Jeff, you are at Prologis, the global leader in logistics real estate. And so, as someone who works with institutional investors, can you share some insights about the types of questions they ask and how that drives process and how that drives decision making? Maybe touch on how that extends to supply chain too, if you can.
Absolutely, and thank you, Holly. And just by way of quick background or context of why we're so focused on resilience is Prologis owns 1.3 billion square feet, and as Holly mentioned, primarily of its logistics and distribution or warehouses in about 20 countries. A lot of it's susceptible to natural hazards and earthquakes and the like. We also we develop on our own. So similar to what Willie mentioned, we not only own and operate the real estate, but we develop real estate. We're also the second largest owner of rooftop solar right now, and also merging sort of the energy and the logistics world to develop data centers. So resilience is at the forefront. Our engagement with institutional investors is we operate 9 different funds, and I've been in this role for 20 years, and the questions that get asked by institutional investors evolves. 10 years ago, maybe we got 2 questions just on risk in general. Then risk became sort of an area of focus, and you get 2 pages of questions. Then became maybe questions about cyber. Well, nowadays, a week doesn't go by where there's not a question about what are you doing to manage against potential interruptions, to the frequencies and severity of weather events. And, call it climate, call it whatever you like, but the reality is that especially within supply chain and logistics, the potential for interruptions is there. And so each week we're responding on operationally, what are we doing? From a physical characteristics perspective, what are we doing? And then how are we monitoring that? And we'll dive into that in a little bit. But what tools are we using to understand our exposure? Now that's both with institutional investors. Also, across that 1.3 billion square feet, it's been estimated we probably have about 3% of the world's GDP flowing through our properties on an annual basis. And so the customers are laser focused on their own supply chain resilience. And that certainly, I mean, there's always, every time there's a disruption, an interruption of some sort, it's the awareness is going to arise. I mean, COVID clearly, ratcheted it up, but since then, think of the number of disruptions we've had since then. So this goes beyond weather to all kinds of different types of disruptions. But so we look at it from a broad brush of resilience. And then, and then I'll dive into more of what we're doing from a natural hazard perspective in a little bit. So.
Okay, thanks, Jeff. So, Mary Claire, as climate and environmental credit risk for a lending institution lead, can you help us further explore how this shows up for different stakeholders? I understand this might look quite different in different market segments. Can you help us understand the contrast between institutional investors and maybe middle market players?
Absolutely. Thanks, Holly. We're really starting to see this bifurcation in the marketplace based on real estate sophistication. So your very sophisticated property owners and developers are considering resiliency measures in their development process. When you start to look further down the line, let's say to a middle market client whose primary business is making a widget, that may not be a very intuitive question for them to ask next. And then when you're thinking about all of these folks have either private money, but let's call it bank debt behind them, you start to follow the money, right, from a bank down to the borrower. So you could have a bank lending money to a borrower. That borrower could be a short-term developer who's just looking to develop the property and have it taken out by some sort of a takeout lender, pension fund, whatever it might be. Or you could have someone who's an owner, operator, investor who's going to stick with the property. They have a different time horizon. And I know we're going to talk about time horizon again later. But let's say it's an owner operator and they're going to have a tenant. And then that tenant makes a product. And that tenant relies on suppliers to get them the pieces to make their product. You start to see on down the line that even as a lender, you want to start following the money. How is that loan going to get repaid? Right? If the tenant cannot make their widgets and can't bring their widgets to market, then they can't afford their rent. And if they can't afford their rent, then all of the pro formas that the bank made on initially lending to that building are off. And that's when you start to see credit deteriorate, and that's when you start to see loans go into default. So it's kind of that beginning with the end in mind. Where's the actual repayment coming from? And what are the risks associated with that repayment?
Thanks, Mary Claire. Let's move into some practical solutions that are implemented in commercial real estate. And while we're talking about these, we can think about how they intersect with community resilience and infrastructure. So I'd like each of you to share examples of how developers, lenders, and owners can reduce damage from natural hazards and what are the financial drivers behind these decisions. So I'm going to go back to Jeff here on this one.
Okay, thanks. I think we could look at it from two lenses. I mean, the response could be very complex, where we've had situations, say following Superstorm Sandy, where we've had customers near the Port of New Jersey saying, never again are we going to be disrupted the way we were. So we helped them develop an asset, raising the base floor elevation, tens of feet, was a pretty sizable increase. But you wouldn't solve that just by, within the boundaries of our property. It took coordinating with the local governments and all the jurisdictions over, the water flow and retention basins and other aspects like that to really create a resilient property. But maybe another area I'd like to focus on quickly is just, the hurricanes or the major events often get a lot of the attention, but what's been impactful to the insurance industry and their experience over the last few years, and us as a large property owner, is really that category of severe convective storm, which could be hail, it could be tornadoes, it could be derechos, you name it. We've now come up with a name for all the different kinds of events. But those could be maybe smaller in size, but because of the frequency, because of the variability now with seasonality and severity of these events, that's where we are seeing the greatest impact. However, I also think that ties in with some of what we would call, in air quotes, probably more simple solutions. And that could be everything from tying down HVAC equipment so it doesn't blow across your rooftops and pierce the roof membrane to ratcheting down gutter systems. There could be some simple things you could do to moving electrical equipment off the ground floor and ground levels. So there's been a lot of, every event has created an opportunity for us to learn from it, but a number of the instances are probably quite sort of simple to implement and to keep things resilient. One final example I'd say is, guards around HVAC units. Well, what's the difference with, when do storms hit? They hit in the summertime. When do you have damage? Maybe in the summertime of Houston, so if you didn't have an HVAC unit, you might be sitting in line waiting for a repair. A replacement versus just a quick repair and allowing operations to still go into the building. So I'll hand it over to the rest of the panel.
Everybody, this is Holly. I got kicked off here on Zoom, but I'm back on the phone. I think we were going to go to Willie next.
Okay. Those were some great examples, Jeff, and kind of when I was with the global developer, I'm with the smaller developer now, but we were doing those things too, and because for the same reasons that you said, I mean, it was about reputational risk, it was about providing some sort of incentive to tenants to come rent from us. And also just being resilient. I mean, understanding that resiliency can have a positive effect on OPEX and CAPEX. And that's, we'll talk about financial metrics in a bit, but that's important. So one of the things that I just want to add to the things that Jeff mentioned that is a lot of times fairly easy to do is to, in areas that are prone to flooding, to make sure that your access roads, on your property won't flood. And that can extend off-site, although I think we have a much more limited ability to affect that, but certainly if it's on site, we can raise the grade of the roads. We can choose to use what's called dock height buildings, which are up 4 or 5 feet, so the trucks come right up to the dock as opposed to coming down a truck court, right, which tends to flood. So there's things like that that can be done. We're going to dive in a little bit to the metrics, some of the financial metrics and some of the factors that weigh into this process. But if you can do it inexpensively, so it doesn't move the needle that much with regards to the cost of the building, and thus the commensurate cost of what you have to charge in the lease to cover that cost, it's a win-win. And those aren't things that are hard to convince folks of. Where it gets a little harder, I think there's other things, and we'll talk about that we can do to help with that. But it is a bit of a paradigm shift in terms of how we think about some of this stuff. Holly?
Yeah, so I was going to go to Mary Claire now to talk about what's happening in the lending side.
Thanks, Holly. So, there's a phrase, at least lenders like to use this phrase, and it's a little tongue in cheek. But, banks are often seen as the de facto regulators. We are the great enforcer, right? If you want our money, then you have to do X, Y, Z. And I think when we're thinking about resiliency, the greater commercial real estate industry is really waiting to see what banks are going to do. And I think there was some conversation about that earlier about enhanced lending opportunities that would encourage more resilient construction practices or reward folks who did choose that path, perhaps voluntarily at this stage. But I think in this topic, banks are sort of sitting back and looking at the insurance industry and thinking, well, the insurance industry is really going to be the one that pushes resiliency. In the central bank scenarios that were tested, be it the Bank of England's test or the United States Fed's test, the primary risk mitigant in the commercial real estate space was insurance. And the assumption was insurance would be available. The test did not stress the insurance availability or even insurance pricing. And I think that anyone who's been working in this space knows what the headlines are. That seems to be the actual risk at this stage of the game, is the affordability and the availability of insurance for your structure. So when we think about that, if insurance is not available and the risk of loss begins to shift back to borrowers, and in the event of default for lenders, it'd be really nice to see some greater acceptance of resilient strategies with a reduction, perhaps in premiums, or an increased comfort in providing insurance in given markets and in rewarding folks for those efforts. The other thing I think that becomes a bit of a neutralizer in this is building codes, right? The law requires that structures are built to a building code. And if you go above and beyond, it could be costing you a premium. And for that premium, you're hoping that you're going to be able to recoup additional rental income. And in the case of resiliency, hopefully you're building a structure that is able to withstand greater weather-related risks. But it would also decrease the cost of insurance and overall make insurance more affordable. And perhaps it would even lead to a reduction in losses and greater profitability for insurance companies in the long term. So when we think about resiliency and the relationship between insurance and banking, it's not just even insurance and banking, right? It's the developers, it's also building codes, it's all of these groups coming together and deciding what's the best way forward.
I think, Mary Claire, I've been hearing about lenders getting increasing a number of requests from borrowers asking for exceptions to their insurance requirements because the borrowers simply aren't able to access that type of insurance, or the insurance that they're required to carry is too expensive. So they're going back to the lending institution and asking for exceptions. And I think as that type of activity happens, then that conversation between insurance and lending will continue to occur. And we hope to see more incentives. I'd love to see more clarity. I guess another thing I would mention is a lot of property owners are now collecting COPE data, the construction, occupancy, protection, and exposure data during their due diligence and providing that proactively to insurance. I think one of the questions I hear a lot is, well, if I invest in resilience, will I get a better insurance cost and a cheaper premium? And I think it's sort of like the wrong question to ask. I think, and the folks from FM could answer this better than anyone, but there's the building attributes influence the pricing. And so if you have accurate building attribute information, and if that building is built to good standards, then it will be better performer and it will be able to be insurable. So I think sometimes it's how we frame those questions too. Willie, do you want to touch on that one at all?
No, I don't want to delve.
Insurance pricing and resilience.
Yeah, I don't want to delve too much into insurance because there's going to be some panels later that talk about that and some insurance people. And I thought the presentation earlier that included FM was insightful. I'm very familiar with them because over the last 20 years, I've interacted with them quite a bit on buildings that are owned by the companies that I did risk management for, so I think we should move on.
Okay, let's dive into how factors like building size, tenant type, and investment horizons affect resilience choices. Jeff, maybe you could touch on that.
Certainly. And so I think some of the opening comments today was around, our presentation here is about following the money, right? And so nothing in life really gets, if you're coming from commercial real estate side or business side of things, there's very few things that happen if they don't pencil out and make business sense. I think, just looking more broadly, Prologis has done a lot in the area of being, a good community partner, trying to be at the forefront of sustainability but we would only do that if it makes good business sense, which it does, to put solar on roofs, etc. The other side is it also makes good business sense to make sure we have highly performing assets over the long-term horizon. And, we are a long-term owner of our real estate. And you can imagine we'll have a very different calculus on what an investment in day one and paying for that over time for a more highly performing asset, both financially performing and operationally performing asset over time. That's a very different equation than if I'm a developer who's trying to sell right away.
Mm-hmm.
And so that was one area. Two is, I think, by asset type. Well, I have always thought that the industrial real estate sector has had the fortune of being, quite resilient from the concrete construction, raised floor heights, and just sort of that mindset around the movement of goods and logistics. I'd say that there's, there's similar interesting questions that can be raised for the other asset types if it's multifamily residential, and where we're building those in hazard prone areas. And then where do people like to stay when they go to hotels? That's generally a lot of hazard prone areas as well. But so a whole nother set of factors around resilience that need to be considered with a different set of stakeholders. But within real estate, I think time horizon definitely would be a key factor in decision making.
So for this audience to be thinking about who the champions for resilience are, I think industrial and hospitality are already there. I've been thinking about these issues, data centers for a long time. Mary Claire, do you have anything you'd like to add on that one of how building type or tenant type, investment horizon affect decisions?
Well, yeah, and I think it's something that we've touched on briefly, but that concept of the payback period, right? The how long you're going to hold on to an asset is a very big factor in your payback period. So that initial investment that you make, divided out over those years that you were going to be connected to that asset, and you start to be able to do a lot more the longer you hold on to an asset. An interesting piece of information that we've used in some of our research internally that is publicly available is for every dollar spent on a resiliency measure, you see about a $13 return. Now, if I could have invested all of my initial dollars and known I would have gotten a $13 return, I may not have to be part of this panel today. I could be enjoying a beverage at a weather event prone area of the world. However, I am here, but that's a fairly good savings or return on an investment when you're thinking about this planning piece. When we're thinking about a community's resilience in response to a significant weather event, I always jump to that infrastructure and those first responders and making sure that the helpers are able to get through. And we all benefit when a community is more resilient overall, right? Cars can get through on roads because ambulances are getting through on roads. Hospitals remain open. That those potential, there's that potential for the greater area to bounce back faster when a community itself is more resilient. There's also this interesting market dynamic, and this is going back to building codes. If some resiliency measure is required by code, then we've got this level playing field. When a resiliency measure is not required by code, it's seen as a premium. And I think that that's a very interesting market dynamic. And there's probably folks on both sides, right? There's folks on the side that say, oh, well, we should have it all in the building codes. Everybody should be playing across that level playing field. But then there's the argument for market dynamics, right? What are people willing to pay for if it's not required in the codes? And I think we're starting to see that play out in the marketplace.
Mary Claire, do you think that lenders understand that codes vary across the United States?
Right, so lenders, right, the generic term lenders, any lender is made up of your client interfacing person, your underwriting person, the credit risk approval person, the internal audit person, the checker of the checkers person, right? There's all these layers of people involved in being a lender. Who knows what is very different at each of those levels. So does your client facing, whether you call it a relationship manager or a banker, do they know? No. In some cases, they might, but overall, I would say no. But then who does, right? They're usually the boots on the ground. They're the local face of the firm. Those nuances across the country are really, they're very complicated, especially if you're sitting in a national seat. You know, it's hard enough to keep track of federal regulations. Then we have 50 states with their own regulations. And then every municipality has their own building codes. That becomes very tricky.
So I think I want to make sure we have time for questions from the audience. So I'm thinking I'm going to transition now to thinking about getting your future comments about where you think this is heading. Jeff, from your seat, what do you think the future looks like from a resilience perspective? What are the drivers? What do you see coming?
Well, there's already a lot of effort around how do we assess resilience, probably in a similar way to how we look at other building characteristics and or environmental site assessments, et cetera. So around the standards there, if we could have a common language around defining resilience, that would, I think, be very helpful to, you know, so that the stakeholders are sort of on the same page there. Another area is right now the models, setting aside sort of the natural catastrophe models that have been around for 30 plus years, but more looking at the climate risk models. Those are very good at telling us what our hazards are at the locations where our properties are, but I think are still on the cusp of really integrating what Holly, you mentioned earlier, is that really that building characteristic information so that we truly get to more of a risk score. The final thing I'll speak to is just lightly, because I know we're saving the insurance discussion for future panels, but is tying back. I think the process still is very much around evaluating risk, and I feel like, but I do feel like they're moving in the right direction with FM being the prime example of that, of rewarding resilience, and part of that's going to be that people like Prologis might decide to take on more risk because we feel, you know, we're taking the right steps to become more resilient. But I do think at some point it will be a partnership in that area. But
Thanks, Jeff. And Mary Claire, I know you're part of the Risk Management Association that a lot of lending institutions belong to, as well as the Environmental Bankers Association, which is also looking into this topic. What do you think the future is in terms of lenders looking at this natural hazard risk in their risk management programs and policies going forward?
Yeah, thanks, Holly. I think it builds perfectly off of what Jeff was just saying. I think that we have to get better tools and better models that actually take into consideration specific building attributes to really be able to make those informed decisions. I also think some of the tools, even some of the weather related impact tools that are out there, are taking a better forward look instead of just relying on past data. I think that is going to be a really good thing. That will allow financial institutions similar to large institutional developers and property owners to maybe take some calculated risks, right? With more information and more knowledge, we should be able to understand the risks better, but also be able to mitigate for the risks better. That would be my hope.
And Mary Claire, I know you and I have talked a lot about the lenders are not yet really looking at this on a deal by deal basis. Maybe some life insurance companies who also make loans are, but bank lenders are not. But I believe for the most part, like talking to RMA and EBA, a lot of the large lending institutions are doing this on a portfolio basis, utilizing the commercial climate modeling tools, which, you know, there's pros and cons to that. And I think a lot of that data within those tools is leveraging NOAA information that's been developed. So I don't think they're at the point yet of incentivizing resilience on a deal by deal basis, but I do think they are looking at it on a portfolio level and thinking about how this affects financial risk. So Willie, to you, I know you have thoughts about the future. Where are we going from here?
I guess I get to wrap it up. First of all, I love going after lunch because everybody's in a food coma by now. Half of you are asleep. Just look around you, and that's awesome. You know, you won't remember a thing tomorrow. You'll be like, "What did those guys talk about?" So I did want to say something about market rent. I know in our previous topic we were talking about what incentivizes and disincentivizes, and one of the big incentivizers or disincentivizers is market rent. And when you talk about leases in the commercial real estate world, I think that, you know, they're triple net leases. So the tenant pays for insurance, taxes, operational costs, things like that, that go to maintain the building. And then there's a rent, which pays the owner of the building, and it covers their costs and their profit. And if the market rent is lower than what you need to cover even the amortized costs of resilience, it becomes a much more difficult discussion. So just something to think about. It is a factor. When companies do performance before they build a building, they're looking out a long time, and whether they hold on to that property for that long or not is a function of the deal, right? But nobody wants to build a building and say, well, it's only going to be there for 5 years. It's not the case. They're built and they do, you know, a pro forma that goes out 10, 20, 30 years, depending on what, you know, and those projections get fuzzy as you move farther out. You know, looking towards the future, I think I always go back to what, you know, Howard Conrather at Wharton used to say. He'd say, Willie, business people have short memories. So when they get hit by a disaster or a strategy and get hurt, they're all over it. They want to do everything they can to keep that from happening again. And after a couple of years, they've forgotten about it. You know, they moved on. And so it's the companies that actually follow through on that stuff that actually move the needle and get ahead and become the leaders in their fields, right? And so if you don't know Howard, he was at Wharton, head of the behavioral economics group, and he was a pretty interesting character. So in the future, I think as modeling improves, you know, that means, and I've seen some things at NCAR where NSF NCAR, where we've done some things with resolution, made some improvements. I think there's a lot of focus right now on variability of severity and looking at that. There's some great scientific advances that are happening, so that I'm sure will continue in the future. But with regards to climate risk assessments, Joe Barsugli and I had coffee last week, and we were looking at some of these reports, and Joe very aptly said, hey, here's two reports that have an asset in the same city, but they're using different thresholds to compare the data to. And these assessments use, you know, CMIP 5, CMIP 6 analyses and data. And they, you know, the providers of these, they don't talk to each other. They consider themselves competitors, right? They don't share. And we have in the ASTM Property Resilience Assessment Standard required transparency with a number of disclosures, and hopefully that will continue to improve, right? But there's no agreement on thresholds to use, and that's something that in my future view, I'm going to work very hard to try to make happen. And also, I know this will make a lot of the engineers in the room twitchy, but users that use these reports have their own idea what threshold is important. Like for temperature, is it 85 degrees? Is it 95 degrees? Is it 100 degrees? You know, what is it? If for wind and hail and other things, right? And I've done a lot of work with this, and it varies quite a bit by company. So user designated thresholds is another thing that should be looked at, and alongside with sort of broader, more global ones. I think the work that we've been doing and will continue to do to raise awareness and educate the industry and businesses is huge. The more they know, the better it is for all of us. And so that's a big part of it, and we'll continue to do that. And then finally, I think, our financial partners need to start incorporating business metrics in their climate risk assessments, right? Aggregation, profitability of an asset within a portfolio, or what's driving the profitability of a portfolio versus an asset, business interruption in supply chain, a lot of what we've talked about, and finally, reputational risk, which Natalie spoke to earlier, which is super important, right? And I think we've touched on all this, but that needs to continue and become more commonplace. So, Holly, that's what I see for the future. And hopefully my crystal ball is half decent there.
Thanks, Willie. There's a question in the Q&A talking about supporting your comments about having a common language, or maybe that was Jeff's comment, having a common language. And the commenter said, I rely on ASCE and ASTM to build the piano so we can play. Is there a good website to follow to see the development of the common language and predetermined values of ROI? I think that's interesting. There are a lot of good resources out there. Certainly NIBS has a lot of the ROI information. ASTM has developed a standard for property resilience assessment, but as Willie stated, the risk appetite and resilience thresholds vary depending on users. So to get to a certain rating on a project, really you need to consider who the user is and who's making the decision. Also wanted to throw out, I know Lindsay Bruger mentioned earlier, ULI has a lot of great resilience resources. And one of those that I wanted to mention is a resource that details how design, construction, and maintenance factors impact property insurance underwriting and premiums. It's called the CRE Guide to Natural Hazards and Property Insurance Underwriting. I would highly recommend taking a look at that. But the next question was, timeline question is an interesting one. I'm thinking of real estate that has high turnover and might create less reasons to invest in resilience. Do you think that there are ways to reward resilience during sales to continue that? How would you get a return on investment if you aren't there to see the return? Yeah, it's a key question.
Oh,
Anyone want to take that one?
That's a really good question. And it's funny because we were sort of bantering this about with a couple of appraisers recently. So an appraiser coming out to provide a value on an asset would say that the most recent sale of a comparable building with comparable attributes in the same market area, that's going to provide, right, your incentive that it would be higher. My retort to that is if I live in a townhome complex and all of our townhomes were built at the same time and they were all built with basic builder products, but I significantly upgraded my townhome 10 years in, but my neighbor did not, I would have to tell someone, oh no, my unit's different because of X, Y, and Z. And so I think it's twofold, right? The appraised value is going to be kind of indicative of market pricing. But I also think that when we're marketing properties that have these enhanced features, you have to make sure that you're telling people about them, and then they would get the return. I think, there is an opportunity to be paid even in the shorter hold time frame. It's much easier to calculate over a longer term time frame. But I think that if market dynamics are pushing the prices up, because of certain characteristics in certain markets, I think that you would get paid even on a shorter term. Hopefully that answers the question.
Yeah, Holly, if I can, having been in the development community for a long time and dealt a lot with shorter timeframes like that, there is the pro forma I keep coming back to, and there is an capitalization expense that's amortized over a period of time for that particular fix that needs to be done, whether it's a new roof or whatever. And you can monetize that, right? I mean, if you've dropped your capex because you've built a more resilient building, then that's one way to monetize that return, right?
Thanks, Lily. I think we have time for one more question from Joe Barsugli. Mary Claire, you mentioned the many roles among lenders. I would assume that they use software tools to inform their decisions. Are natural hazards, climate risk incorporated into any of these tools, or should they be?
Existing tools, yes and no. It really does depend. Is it an automatic? I think is part of the question there. No, it's not an automatic.
Not yet.
Jeff, is it automatic for you guys?
Yeah, go ahead.
I mean, we have certain climate perils embedded into our investment committee memorandums, and we run, it's from third-party models, but it's evolving for sure. It's we're in the first inning.
Yeah, I think if you follow the risk, you follow the money, you follow who's paying attention first. So as I said, industrial, hospitality paying attention now, bankers starting to pay attention and starting to experiment with tools. But Dan, I think we might be out of time.
Yep.
I see you're standing at the podium there.
Out there, but I didn't have my microphone on, so so everybody's giggling at me.
Probably better, Dan.
All right, thank you all again. Round for the panel.